Welcome to another episode of Unzip, Reboot, and Leave, an URL podcast. This is Gautam Basak. Today we have someone who is very dear to me and who is into a very different kind of a business, at least in my ecosystem, in my surrounding. And he is a trader by profession, though he is an engineer by trade. So we will discuss on this trading aspect. So welcome, Partha Banerjee. Parthoda, how are you today, sir?
Thank you very much, Gautam. Thank you for the invitation. I'm good. How about you?
Yeah, good. Thank you. Thank you for your time.
Thanks, Tan.
Okay, so your organization is NP Financials.
That's correct.
That's a name. What is the reason of, we will come to the trading later on, more
Yep.
in details, but what is the reason you started this?
Very good question, actually. Till 2010, if I have to go back a little bit, I was in a corporate house and we were doing all sorts of engineering and other portfolio management. But before that, from 2005 and much before that, I believe, I had an inclination towards trading, towards share trading, towards commodity trading and Forex trading. So 2010, so from 2005 to 2010, I started I actually started knowing the system. What is it? What is shares? What is commodity? I was not knowing anything. So I learned, I gave myself 5 years time and then dropped the bombshell at the corporate house and resigned at 2010 at an early age. And then I joined many companies in Australia who were actually in the similar business. I will not name them, but I joined them to know how they are running this organization of training and funding and what is the total fuss about it. So I joined almost 2, 3, 5 companies in the very short period of time. Then I got dissatisfied with the way some things were going, and we formed NP Financials as a actually home based business to start with in the year 2013. The very basic purpose of starting this business way back in 2013 were two, three folds. Number one was to tell the truth to the traders, to the budding traders who were coming in folks, in numbers, to tell the truths about trading and not sell them the dream, not sell them the dream. That's what I saw in the houses were doing. They're selling the dreams to the managers, to the salesperson. Nothing to blame anyone, but not to sell. So the first purpose was to tell the truth about trading. That was the number one purpose. And the number two purpose was to break the myths. There were a lot of myths around. I'll tell you when we go into detail. So there were a lot of myths around trading and making money, because this business is all about making money. And people were selling that, okay, do our course, do our training and all those things, and you'll be millionaires in couple of months. So just to tell the truth about trading and break the myths about trading, I thought, okay, let us try our own business. And we started this business. We registered the company NP Financials in 2013. And being in Australia, you know how difficult or how strict the regulations, financial regulations, especially the financial regulations in Australia, because we have to be governed by Australian Securities and Investment Commission, which is ASIC, number one, which is very tough, very tough. And number two, we need to have our Australian financial services license before even we speak a word about this financial trading. So those two things took us 3 years time. So we got the license in 2016, thank God. And then we were full-fledged from 2016 till that touchwood. So that was the basic purpose of starting NP Financials as a trading organization in Australia.
Okay, good. Now, as if like I also have very minimum idea on it, though I am in business for last 8 years. I also registered my business in 2013. So,
Oh, very good.
what is a trading firm?
A trading firm can be of three types.
Okay.
The first one is a trader training organization or trader training institute, in which traders are trained. So if I have to tell you a little bit story about it, there is actually this is a fact, not a story. Way back in 1970s, if I'm not wrong, two traders in the name of Richard Dennis and Ikard, I think Ikard, his name, his friend. They were trading buddies, and all of a sudden at that time they were millionaire traders. So at that time they had a discussion and they had a bet. Richard says that the traders can be trained, but Ikard says no, 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 traders cannot be trained, and they are actually born with trading instinct. So Richard thought, no, 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 this is nonsense, this does not make any sense to me. So let us take a bet on this. And at that time, remember, way back in 1970s or something like that, they took a $1 million bet out of their pocket that whosoever win will get the $1 million. So they actually started interviewing traders all across the America. So around they screened 2,000. Initially, the screening was 2,000. Number can be a little bit here and there. And then they actually finalized on 40 traders, 40. Then on that 40 traders, both of them, they had the similar principle of trading. So Richard actually started training them. And 40 of them, after the training is over, it was a very simple training. I'll tell you what is that. It is a very simple training. The way they were training way back in 1970, they were buying on 40-day breakout. They were selling on 40-day breakout of the downside. So this is a very simple thing. And most of the traders, 20 of them or more than that actually did very good, and turned maybe $10,000 or $20,000 into $1 million accounts. So that entire process was known as turtle trading. Turtle, Turtle, turtle trading. If you know, in Singapore, they have a very strong turtle breeding as a household pet. So that is where the name came from. That is where the name came from, Singapore, turtle trading. And there are very good traders now in the form of Curtis and others who are very well trained in turtle trading. So the bottom line is, it was proven to the universe that traders can be trained. So that is number one. So the number one organization is Trader Training Institute. Trader Training, where we provide training. That is number one. And number two is trader funding. Trader funding, it is also known as nowadays prop trading. It was not there before, I would say, 1919, 1920. Before COVID, it was not there at all. Not there at all. So this was known as trader funding. We also did for 4 years, from 1919 December to 2024 January. We did the trader funding, in which we run an audition or a challenge. So if you are a trader, you come to us, you pass our audition or you pass our challenge, and then we'll evaluate you according to our laid down criteria. So we'll evaluate you, and then if you pass, then we will be giving you live money or demo money, and then we'll be having a profit sharing. Of, you'll be getting 80% as a trader, we'll be getting 20% as a firm. So that is known as prop trading. That is for funded trading. So one is training type of training organization, and the other is funded type of trading organization. Is it clear?
Yep.
If it is not clear, please ask question, because I have a bad habit. If I try to speak, then I'll continue to speak.
No, no, that's fine. That's fine. No, it's easy. Yep.
Yeah. And the third one is train the traders such a way that they are not trading their funded account. They are not trading the little account. They have 5,000, 10,000, but they are trading their life saving. That means SMSF. So they are trained to trade the SMSF. So that is self-managed super fund. So you can actually trade a self-managed super fund if you are professionally trained. So these are the three types of organization, and we have done all the three. I hope I have answered your question.
Yeah, yeah, sure. Okay. Now, we will go into that one by one as you are into training and all. Now, give us a little bit of an understanding of the differences. Okay. So I understand what is, shares. Okay. Okay. What is share? A little bit I understand.
Yeah.
I have no idea or very little idea about these four things: commodity, indices, forex trade, and crypto.
Yeah.
So, can you please give a bit of an idea on that, or what are the differences in that?
Yeah, absolutely. There, as you said, there are rightly said, there are five asset classes. One asset class you already named, it is share trading, that consists of stocks of companies. The stocks of companies, if you see, you know, you told that you know it a little bit. If you know, it is valuated for under different criterias, and the main valuation of stock of a company, or may it be Apple, may it be Amazon, or CSL, or Cochlear, or Tesla, or Telstra, even anything. So they are derived from management quality. Number one, there are many criteria. There are many criteria. The number one criteria is the management quality. So that is number one. And number two can be product quality, and the innovation. And the number three can be service quality. So based on three, and based on lot of financial ratios like profit, like price earning ratio, like EPS, earning per share, like ROA, return on equity, like cash flow. All these are criteria. All these are financial ratios in which you can evaluate. You can evaluate the stocks, and this has been going from long. Warren Buffett, you know, that guru of share trading or stock market trading. Now he's not doing trading though. Now he's doing basically investing in companies, buying and selling companies. But when he started long back with $125,000, his guru was Graham. Graham taught Warren Buffett how to trade, and basically they were searching for low price earning ratios companies, and they are investing money there. So if you study a little bit about Warren Buffett, he started with $125,000. Now he's having hundreds of billions of dollars. So this is all about share trading, which is governed by the management and product and service quality. And then second, I'll talk about is the commodity. Commodity. The owner of commodity trading is Mother Nature. Let me first tell you the commodities. What are the commodities? We generally use from every day, may not be every day, maybe for long term. Like gold. Gold is a commodity. Silver is a commodity. Like crude oil is a commodity. Rough rice, wheat, corn, natural gas, live cattle, orange juice, high grade copper. All these are commodities. So, really speaking, you cannot go and buy some live cattle and make money, can you? You cannot buy rice and make money. We consume rice, isn't it? We consume rice, we consume wheat. That way we know then to buy rice or buy wheat. But thanks to CFD, contract for difference, thanks to CFD, which is known as contract for difference, this is a derived product, is known as derivative. In India, it is known as derivative. In Australia, it is known as CFDs, contract for difference. And in America, it is better known as option trading. So they do a little bit of different derived product, but everywhere, whether it is option trading or CFD trading or any other form of derivative trading, like futures trading, all are derived from the underlying instrument. So all are derived from the underlying instrument. So underlying instrument is rice. Underlying instrument is wheat. Supposing I'll ask you a small question. I told you Mother Nature is the owner, basically. If I ask you, if there is a flood at Queensland, what will happen to the price of banana?
Normally go up.
It will go up because the demand stays there and the supply is not there. Mother Nature, through flood, has restricted the supply. So this commodity is such a asset class which is mainly controlled by Mother Nature. So if there is a flood in India, Bangladesh, Sri Lanka, and Pakistan, there will be shortage of rice, and the rice price will go like crazy. So did I explain you commodity?
Yes.
Now go to the indices. They call it indices or indices, whatever you call it. So indices are nothing but a basket of stocks or basket of shares, like we have in Australia, ASX 200, Australia Stock Exchange 200. That means the top traded 200 companies in Australia, they are being indexed. Their performance is being measured and based on their market capitalization. These subjects are very big, but just to shorten it up, based on their market capitalization, there are indices to tell us how the top Australian 500 companies are doing, or the 200 companies are doing. Similarly, we have Dow Jones 30 in America. In United States, we have Dow Jones 30, which is the top 30 companies. Similarly, we have S&P 500, SPX 500, the top 500 companies. Similarly, we have NASDAQ, in which the technological companies are there. So these, like Apple, Amazon, Tesla, sorry. So these are indices, a block of stocks performance. That is plain simple. And forex we trade, all of us trade forex, because if we go to America, we have to trade our Australian dollar to fetch United States dollar. If we have to go to Europe, we have to sell our Aussie dollar and buy euro. If we have to go to India, we have to sell our Australian dollar and get INR. So this way we are participating in foreign exchange. Every one of us is participating in foreign exchange. Out of these 5 asset classes, the forex is the biggest one. $6.6 trillion transacted in one day. In one single day, $6.6 trillion is transacted. And we need to remember, 1 trillion is 1,000 billion and 1 billion is 1,000 million. So it is humongous. That is why we don't have any, maybe 20 years back, this was only available to financial institutions, big financial houses like banks, like mutual fund, hedge fund. It was available to them. But thanks to the derivatives, now we can trade foreign exchange with a little sum of maybe $1,000, maybe $5,000, maybe $10,000, with the advantage of leverage. I'm not going into leverage because it will complicate the things. So leverage means it will multiply. Supposing you are putting $3,000 in a broker account, that will multiply by 30 in Australia, 30:1. And that will give you a power. That will not give you the money. That will give you the power to trade 90,000 value. So that is how we control, we trade forex. And who is the controller of forex? No one controls foreign exchange. This is a paradox, that forex is foreign exchange. Although there is a word exchange in there, but there is no exchange in forex. It is decentralized. You sell, I buy, someone sells. So it is a decentralized product. But main drivers of this in forex is, this is a directly derived from interest rate. Country's interest rate. So the more the country's interest rate, the more powerful is their rate, foreign exchange rate. So what is who decides on the country's interest rate? There is a fellow called Reserve Bank Governor, Reserve Bank Governor of Australia, federal chairman in United States, Bank of England governor, like that, Bank of Japan, so they actually, with their colleagues, they decide on the they have a target. They have a target of inflation. They have a target of CPI. They have a target of GDP. They have a target of interest rate. So if you ask me what is the main job of a governor of a reserve bank, the main job of a governor of a reserve bank is to control the inflation, so that inflation is not going down or going up or going down. So that is the main purpose. That is why they control the flow of money in the economy. So that is somewhat related about foreign exchange. That is a very vast subject, but I hope I can explain you a little bit.
Yep. And the last one is crypto.
Now, foreign exchange is somewhat is being governed by, no one can control. Someone is being governed by the Reserve Bank, right? Reserve Bank. And cryptocurrency, seeing these, that money is being controlled or somewhat governed by the Reserve Bank, or the governor, or the president, or the treasury, or the financial ministry, something like related. Something is now related. So a boy, actually a little small, I would say teens, they started a digital currency, which is known as cryptocurrency. The main digital currency, as you probably know, is Bitcoin. The price of a Bitcoin in 2012-13 was below $300. below $300. And when we started teaching the breakdown how to trade, and we also traded Bitcoin, now it is $77,000. Okay, so Bitcoin is digital currency. It is not governed by anyone. It is not governed by anyone. So no central government, no president, no prime minister, no treasury, no finance, nothing. So it is digitally kept in digital wallet. It is digitally kept in digital wallet, and then we transact through digital currency. So this is digital currency. If you consider, if you go to West Palm Bank and give $10,000, after you give the $10,000 to the teller, lady or person, then you see only the 10,000 number in your account. That is also digital, isn't it? That is also digital. Digital currency, and yeah, it is not governed by anyone. So I hope I have done the justice.
Okay. All right. So you already mentioned there are three types of like a trading firm we can have. Now, if someone wants to open a trading business, what are the steps? So
You mean learning and making money, or?
now, like if someone wants to open a trade business, okay, he has to go through the licensing process and the certification process and the compliance of it and all these things. And then how they basically generate income out of it.
Yeah, very good question. They can generate income as we can talk about us. We cannot talk about others, but how do we generate income? Is there are three ways a firm or trading organization or a company can generate money. We generate money in the number one process. We trade our trust account. So we have a money XYZ amount, and that in the trust, in the company trust, and then we trade that money. We make money sometimes, we lose money sometimes, because it is a hardcore business. It has to be considered as a hardcore business. 70% of the time we'll be winning money, 30% of the time we'll be losing money. Net, we need to make money. So that is one way to trade your own trust account money, number one. And the number two, you can also trade other companies funded account. So they are giving you $1 million to trade because you have passed their audition. You have passed their audition. So if you trade $1 million account, if you make only 3% a month, if you do only 3% a month, that is 30,000 US dollar. So you get 80% of it, they keep 20% of it. So then in that case, that is the second income through funded trading account. And number three account, of course, we spend our time, we share our experience. So we charge for our consultancy. So these are the three types of revenues which are earned by us or any other, I believe so.
Okay. All right. Great. Now, definitely there are a lot of talk in the town, in the world about AI and this algorithmic, trading, and those things are evolving. Okay, and I also have a little bit of money in mutual funds and stuff. So I try to understand a little bit, which is kind of required, but I am not very much aware of it. So how this is different from manual trading, and is there any way to say which is profitable, which is not? Or down the line, we have to be technologically inclined and we have to rely more and more on AI and algorithmic trading?
Very good question. Excellent question. So there are two types of trading. We call it discretionary trading, and the other one is non-discretionary trading. Discretionary trading, in which you are the main person to take the decision whether you will take this trade or not, whether you will buy Aussie dollar now or whether you will sell Aussie dollar trade now. That is discretionary trading, which depends on your understanding, on your capability, on your expertise. Discretionary trading, this is discretionary. And the other form of trading is non-discretionary. Non-discretionary trading, now the latest name is AI, artificial intelligence, but they do non-discretionary trading. Non-discretionary trading was there 40-50 years back also. Goldman Sachs or HSBC or Barclays, they used to do, or Phil Simons, the who converted some thousands of dollars to billions of dollars. They did non-discretionary trading 50, 60 years back. Now we are knowing AI. Now they are selling a black box in the form of AI that this will make money. But discretionary trading was there 400 years back when you might be knowing Munehisha Homa. Munehisha Homa was a rice merchant in Osaka in Japan, and he used to trade rice. I told you rice is a commodity. He used to trade rice, and he invented candlestick, a form of representing open, high, low, close of price for a day. So that is a candlestick. I'm not going into that details, but Munehisha Homa traded rice in Osaka, Dojima rice merchant in Osaka, Japan in 1750. So he was trading in discretionary. How do we, now we need to remember, how do we trade discretion? How do I trade non-discretion? In non-discretionary trading also, human brain is involved 100%. So human will write a program and tell the computer, you do this. If these things happen, you buy. If these things happen, you sell. If these things happen, you do the profit booking. If these things happen, you get out of the trade. Right? So these all are programmed in a non-discretionary way through computer coding. Now people are claiming that artificial intelligence can do. I'll not comment on that. I'll just give you some ideas on that.
Okay.
So before I give an idea, we all trade price, isn't it? Price either goes up or comes down, right? So before I go any further, I'll ask you a simple question. How there is no correct or wrong answer in trading. The only answer is correct answer is the answer which is making money for you if you are a trader. Now, if I know you are not a trader, but if I ask you what is price of anything, how do you define price in one single line or two single lines?
Complicated. I mean, yeah, whatever was previously there.
Yeah,
That's it.
very good. Very good. Excellent. What was previously there? Like Coles said that dollar kg, banana kg is $2.50. That is the price. Yeah. At NP Financials, we have tweaked a little bit. At NP Financials, if you ask anyone what is price, we'll all say that price is a plot of human emotions of greed and fear. So I was telling about price. Price is we say that price is a plot of human emotion of greed and fear. So if we are fearful that the gold is too much priced now at $2,700, we will sell. If we are greedy that oil is cheap now at 70 cents, we'll buy. So that is this is very much cemented in our limbic brain. This is very much cemented in our limbic brain, which has not changed for last 20,000 years. I repeat, our limbic brain has not changed much for last 20,000 years because of amygdala, because of hypothalamic pituitary adrenaline, that HPA, all those things, physical thing, it has not changed. In back then, we were fearful of lion, we are fearful of jungle animals, wolf. Now we are fearful of losing job. Now we are fearful of losing money. So the fear is constant. Fear is constant. Similarly, the greed is also constant. So based on this, we trade discretionary. We trade discretionary. So just to put in Warren Buffett's word, buy D, sell P. So if it goes up, sell, and if it goes down, buy. In other words, also, Warren Buffett said that be fearful when people are greedy, be greedy when people are fearful. So very simple, very simple. So this is what everyone tries, but depending on capability, depending on expertise, they program it and then they ask the computer to do it. But I have many good friends who are trading non-discretionary. That means they call it programmatically trading or robotic trading or BOT. And now the latest trending word is AI. AI is doing everything. They are cleaning our household things also. So is that like that? So with due respect to AI, with due respect to everything, I have seen people who are doing non-discretionary trading. They are more hooked to the screen than we are. We spend only half an hour or 1 hour in a day to see how our trades are going, but they spend 2 hours or 3 hours in a day to see whether they have written the program correctly or not.
Mm. Yeah.
So that is the difference between discretionary and non-discretionary.
Okay. All right. Now, this is a perception question. Maybe I'm totally wrong in it. Uh, Indian market is little bit more volatile than Australian market or US market because it is big. It has a lot of variables. That's why it's beyond our understanding than Australian market. So, is there any way to understand which market is volatile or all market is predominantly same?
Very good. You already answered your question. All markets are same, predominantly same. The scale of variation can be different. Australia market in a day can move 50 points in a day, average day, and Dow Jones can move 300 points. So, but they both are moving in the same direction. And let me warn you, same time, at the same time also. People say, oh, yesterday Dow Jones went up, today I will buy ASX, that will also go up. False. Wrong statement. Wrong. You know nothing. When Dow Jones went up, now we are trading 24 by 7, 24 by 5 at least, 24 by 5. Because Middle Eastern countries like Dubai, Saudi Arabia, they are open on Saturday, Sunday. They are closed on Thursday, Friday. So 24 by 6.5 or 5.5. So all the markets are equally volatile. All the markets move at the same time thanks to the 24 by 5 nature. Now you have a office. Goldman Sachs is having an office at Sydney. ANZ is having an office in Mumbai. So all they are connected. So market never sleeps. And the volatility is the same. And I'll just give you a simple example. In 1990, this is the change. To answer your question. In 1990, the total of this of United States of the total pie is 100. The total pie is 100 of share market. The share of that 100 for United States was only 14.5%. 1990, 34 years back. China was 5%, Australia was 5%, Great Britain was 15%, Germany was 12%. Now in 2024, the share of the 100% pie of America is 60%, 60. Australia is 2%. China is 2%. United Kingdom was there 14%. Now it is 2%. India was 0% then. Now it is 2%. So that way you may say more money is flowing and traded in United States than compared to India, than compared to Australia. I hope I have cleared your question.
Okay, so more money is traded, but the volatility factor is pretty much similar across all the market.
Same, exactly the same.
Okay. Okay. Now, you already touched upon this, but we want to go a little bit. So for a trading, is it more into like an individual behavior or more someone's psychological structure or someone who can handle stress more or because I am in business, I understand, the pluses and the minuses and all these things. So um, like, is there any balance of it or we need all of it kind of?
Yeah, I think you have touched upon two things. You have touched upon the psychological part of doing a business in general and trading in particular, and
Yes.
how to balance the work-life balance, how to do through trading if you are trading, right?
Yes. Yes.
Yeah. So I'll take these as two questions and answer the first question first, and then the second question second. Trading. If you read the book written by Munehisa Homa in 1755, 400 years back, he wrote a book on trading psychology way back in 400 years. 400 years back, he wrote a book on psychology, and he said the psychological factor is very much critical in the success of a trader. Good that he wrote a book in 400 years back. Now, the psychological factor is equally or more important now. So, what are the psychological factors? to be successful in trading is a hardcore business. I told you already. We have named trading as a business. We call it is a business of the name of the game. We call it this way. The name of the game is discipline and control, not greed and speed. Not greed and speed, but discipline and control. So if you are trained in disciplined way, if you are trained in a controlled way, how to control your emotions, that is why we are extremely big in psychology, and we are very fortunate to have Kerry Brown, our brain scientist and psychologist at NB Financial. Not because she is in because in NB Financial, but she is very good in the form of Kerry Brown, who helps our traders, who even suffered the psychological problem after 6 years or 7 years of trading also. Because greed and fear will stay with us as long as we breathe. So to get psychological balance, I would not say edge. Edge is very, very tough. Having a psychological edge is very tough. But to balance psychologically, we need to balance our greed and fear, and we need to balance our emotion through a discipline and control approach. So that is the psychological aspect. And the second question you asked is
individual, like a personality.
Individual. How do I? Yeah, very good question. So that is why we have broken our trading into 3 different time frames. So we call ourselves time rich because we don't have any other job but to trade. So we are time rich, means we do not do job 9 to 5. So most of the people are time challenged, and they are working 9 to 5 and then learning trading to diversify, to have growth, so on and so forth. So that is why we say if you spend 45 minutes a day, and that sums up to 5 to 6 hours a week, you will learn very well. If you do 6 to 7 hours a study per week, that is 45 minutes a day, and then you work 9 to 5, and then you do your house course and balance your trading life. So 45 minutes dedicated time is required for trading. So I don't think it is very much difficult to spend 45 minutes, to invest 45 minutes of time for your betterment, for your growth, to earn money, and so on and so forth.
Right. Okay. Now, a little bit of technical question, which, because I'm from a maths background, so I have this. Uh, how to identify high profitability versus high probability trade ideas?
Oh, it's a beautiful question. It's an excellent question. Yeah, mathematics can help in trading, actually. Jim Simon, whom I'm talking about, he lived up to 88 years old. He died recently in the month of May. He was a terrific trader. He was a mathematician come trader. He was a terrific trader. So that is very I would say thin line between 3 things. Let me stretch your question and add one more aspect. One is profitability, one is probability, more probability. Okay, so talking about probability, I'll first touch upon the probability. Talking about probability, trading is a business of probability. Trading is a business of chance. Talking about chance, obviously gambling comes in our mind, isn't it? So there is a very thin line between difference between gambling and trading.
Yes, and there is also some misconception in the market that whether it is actually gambling or not, who doesn't have much idea on it.
Yeah, that is why I touched upon gambling.
Yeah.
So in gambling, all of us know, in gambling, the odds are always in favor of the house. No matter what you do, they will tweak the machine and they will stack the probability in their favor. So they always win. Why they do not always win, but they always make money.
Yeah.
They always make money because mathematically they tweak their machines to participate in all the events, but maybe they will be winning less, but they when win, you lose more money. Yeah. You may be, or I may be winning. If I go to a casino, I may be winning $20, $100, $200, $1,000. Oh my God, I'm a tremendous gambler. And then the next bet, I'll be losing $5,000.
Yes.
So that is gambling. So the very thin line between gambling and trading is, in gambling, all the odds are always in favor of the house. But in trading, through mathematical and scientific coding or reasoning, coding or reasoning, you can stack the probability. We can stack the probability in our favor. So that is known as mathematical age, and that the trades which are generated through mathematical age are known as high probabilistic trade. That
Right.
means it is having a probability of 70% to win, 30% to lose.
Right.
I hope
Right.
I have answered your question.
Yeah. Okay. So, and profitability is like from the like historical graph, how the business or the asset or whatever it's performing based on that kind
Well,
of a thing.
yeah. So it is calculated through different ratios like Sharpe ratios, Sortino's ratios. There are many ratios. Simply speaking, supposing you start with $100,000, and at NP Financials we are extremely strong on risk management and money management. So we'll not allow you to trade more than 1%. That is $1,000. So if you make money, your $100,000 in one trade will go to 101,000. If you lose money, your $100,000 will come down to 99,000. So this is how you stack money in your favor through your high probabilistic trade ideas.
Right. Okay. Now, as you are in the market, as you have understanding of this, um, like what kind of like yearly cycle you see? Like everything is a cycle, right? It will, what will go up, it has to go come down. So like just give a brief understanding of sometimes what, like, normally we say it's a 7-year cycle, then some said it's a 12-year cycle, bigger cycle is like 100-year cycle, whatever. So like cycle wise, give us some perspective.
Brilliant question. Excellent thought. It is always cycle, and the cycles are actually two types: a big cycle of 15 years, 10 years, and small cycles within that of 1 year, 2 years, 6 years, and small cycles within that maybe for weeks or months. Why these cycles? We need to know why these cycles.
Yep.
There are three types of participants in this market. One is an investor like Warren Buffett, like George Soros. They are big time investors. Paul Tudor Jones. They have a wider perspective of 10 years, 20 years, 6 years. So their cycle is that big. And in that cycle, we have second type of participant, which are known as mutual fund managers, hedge fund managers. They hedge fund. They do some mutual fund business, and their cycle may be 6 months or 1 year or 2 years. We are traders. We are traders. So we see what the investor is doing. We see what the mutual fund manager is doing, and then we participate in that big cycle and medium cycle to make money in the small cycles. So there are three types of cycles depending on who you are. Are you a trader? Are you a mutual fund manager? Or are you an investor? So coming back to the investment perspective, generally speaking, I have seen personally tracking the market from last 100 years through historical charts. I have seen stock market generally cycles around 10 to 12 years. That is why you saw that 2001 dot-com bubble.
Like gone down.
Yeah, dot-com bubble price
Okay.
went. I call it correction. I don't also
Yes.
call it crash. Correction.
Yes.
Correction happened. 2001 dot-com bubble. Then we had tsunami in 2011. See, the
Like
reasons are very different.
yeah,
Reasons are very different.
like GFC also there in 2009.
2008, 9, 10
Yes.
GFC.
Yes.
2008, 9, 10 GFC was there. Global financial crisis. After 10 years, COVID.
Yes.
2020. 2020 COVID. So we may expect something will happen in 2030 as well.
Right.
So in share market, the cycle is generally 10 to 12. That's what I have seen. That's what I have seen. But
That's
in
that's that's the Warren Buffett level, the investor
yeah,
level,
big
right?
cycle. Yeah,
Okay.
big cycle. For
Below that,
us, below that is mutual fund or
yeah,
hedge fund managers.
yeah. For them, it's like 5 to 7 years.
Five, not even that. Maybe maximum 3 years. Maximum 3 years. They
Okay.
hedge. They hedge. They hedge the money. They hedge the money for
So the
one.
last one, when was the down one in hedge and mutual fund?
No, you will not see that way. You will not see that way because it is not big. It is not that big.
Right.
It is, I told you medium. It is medium. It is medium. If the big cycle is correcting on the global financial crisis, if it is correcting 50%, if it is correcting on dot-com bubble 30%, if it is correcting on the COVID 20%, if it is correcting on the inflation 20%, mutual fund will be between that 5%, 10% corrections.
All right. Okay, the cushioning is there, so it will like don't get that much affected. Okay.
Yeah,
Yep.
exactly correct.
Then
And
and
for
then the next one.
and we call ourselves speculators or traders. So we
Yes.
speculate what the mutual fund is doing, what the investor is doing. If they are buying, we will buy. If they are selling, we will sell. So our cycle between 5 to 6 months, that is enough. Even 1 month.
Wow. Okay.
And the
Okay.
day traders, there is now a family of traders call themselves day traders. They
Yes.
they buy and sell in the same day.
Right.
For them, the cycle is a day.
Yes. Okay. So now, like, it's basically comes down to you, which cycle you want to play and how comfortable you are and all these kind of things,
Exactly.
right? Okay. So, as you know me, like, I try to help the other businesses, hoping that the other businesses will also help me. So that's why we are doing this. And to my audience, like, if someone wants to learn more about NP Financials, I will put those details in the video. And if someone wants to contact them, please, happy, I can connect you, or you can just go and directly and talk to them. So thank you, Parthoda. Thank you for your time. Thank you for your wisdom and knowledge. Hope our audience will get some enlightenment out of it. Thank you.
Thank you very much. Thank you very much. It was a pleasure talking to you. Thank you for your time and effort. Really appreciate it. Have a good one. Bye for
No
now.
problem. Thank you.